All right, good morning, everybody. Just starting a few minutes early to mention that the bullish bears has finally got the bots up and running. So on the Discord now, when let's see, get to the right spot. There we go. On the Discord now, we have the Trading bot. This thing is about $200 a month if you wanted to get it for yourself. It's a really powerful bot. Most of the bot commands will be done in one channel, and then these automatic bots are going to do the rest. And these automatic bots are like pre-built scanners that are just doing their job 24 hours a day. They're just looking for this information nonstop, and when it finds it, it posts it for you. This is a tool that we use all the time. Well, we used to use all the time, but we had to reconfigure all of our bots, and they've been down for a while, and we're finally getting them back up and running again. So we have FamBot, Alpha, and Trading back up and running. And then we have Whale also, which is absolutely awesome. Whale Stream is posting in there automatically as well. So just wanted to start a few moments early to point that out. And now we'll bring in the rest of the crowd. All right, good morning, everybody. Hopefully, y'all had a good weekend. I started a few moments early and was talking on YouTube about the bots. We have 3 of our bots back up and running, and then we have an auto feed from Whale Stream as well. And I'm going to be doing a video on Whale Stream soon. Well, we've got Trading back up and running, and the options fam bot and Alpha is back up and running. And I've done a video on this that you can find right above my post where I sent the link. And then, of course, we'll be using these more, and so we'll try to help you guys get familiar with them as we go. It is a quiet morning when we think about what's going on out there for what happened around the world, what we have on the agenda for today. This is the calendar of events for the day. I used the bot earlier to bring it up. We have FOMC member Williams speaking, 2 o'clock, and then these additional auctions. I always pay real particular attention to those additional auctions. To me, they are very often a game changer for midday reversals. But we also want to bring in FX Street and take a look at what happened around the world. Maybe look at the European review. The way that I put together my morning briefings and the way that I try to teach it is to have this consistent morning routine. You go in and you do the same thing every single morning. One of those things that you could do is you can sign up for Bloomberg's email. It's free. It doesn't cost you anything. And every morning they'll give you like a little pre-market briefing. 5 things you need to know is what it's called. So you can go over to them and sign up. And then the NASDAQ website has pre-market filtered scans all ready to go. They're just running in there doing their thing. I like to stop by Finance Juice in the morning. Make sure there's no additional speakers, and you can see we can validate or verify what the bot told us. Here we got Fed Williams speaking at 2 o'clock. What the other one didn't catch, the bot didn't catch, but this did, is that the ECB is having a speaker at 12:30, and then the Bank of England is having a speaker at 10:15. Right, so it's just checking multiple places. And I've said this before: don't trust one source. If you're on, say, FX Street, don't assume that FX Street has all of the information, because they might not. Right, it doesn't hurt to just check a couple of places really quick, take a look around, make sure that you've got an idea of what's happening. I like these market wraps. They do one when we close, they do one when Asia closes, and even though Europe's not closed yet, they know that we're getting up over here in America, so they go ahead and give us the European market wrap. This is very often where you can identify what was moving while you were asleep. Was it transportation, technology, real estate? Because a lot of times we get contagion or bleed over into our own market on our trading day. So especially on a day like this, without a whole lot of additional news, it very easily could have a contagion and carry over. One of the big stories this morning is the Twitter. It was down 7% the last I looked. Earnings season kicks off this week. The dollar is on watch. We've had a lot of posts and a lot of stories about the dollar, and it's literally right this moment getting ready to test the inside day breakout from Friday. Bitcoin had a significant gap down on the Bitcoin futures, and it stabilized along those lows. So it may seem like it was a quiet weekend without a whole lot going on, but we had some pretty big moves, and we're very, very close to parity on the euro US dollar pair. I mean, like, really close. Been watching that thing, got an alert set on it just right? Just in case. GP. All right, so after we take a look at the news, we kind of get an idea of what's going on around the world. Bring it over and start looking at the ES. It's kind of my benchmark, my default go-to. Since it's Monday, it's always a good idea to step back, look out on the daily chart. Now, a lot of times if you go to the daily chart, there's not going to be anything there, but you want to at least come out and take a look. The cyan line that you see here on my screen, that is an anchored VWAP from the first of the year. We are well underneath it. It is valid to note we've started to get some higher highs and higher lows. All right, that white line that I just added is called a linear regression line. It uses things like least squared methods and dot plot statistics. It's going to count every single candle you have. So this is one of those rare indicators that it actually matters exactly how many candles you have. So if I'm looking at it on a year-to-date daily chart and you're looking at it on a one-year daily chart, you and I would actually see two different linear regression lines. Say, for an example, you're looking at it on a 1-day 5-minute chart, and I'm looking at it on a 5-day 5-minute chart. It would be a completely different linear regression line. So one of the tips that I always give people when it comes to using this particular indicator, always look at it on the same time frame all the time. Don't swap it up, because if you change just a couple of candles, this thing can drastically alter what it's showing you. Right? So the year-to-date chart is my go-to for the anchored VWAP and for the LinReg. Kind of put those two together. This linear regression line does a really great job of helping identify where the sweep edges are, right? You got your swing high, swing low, swing high, swing low, like a pendulum. And every time it comes back to center, you're basically back in the middle of the ball court, right? And from there, you can move in either direction. When we stall out and we fail to make what I call a full pass from a swing low to a reasonable swing high when it stops early, right? It's a bit of a heads up. So we've had a number of times this year where we had a swing low and we didn't get an equidistant swing high. Right? The way it's supposed to be is, suppose you move 3% underneath the line, the expectation would be that you would reciprocate back the other way 3% on the other side of the line. That's the expectation. It doesn't always owe us that, but that's what we look for. So we failed to have an equidistant reciprocation off of the low, but we did set a higher low. And right now, if this day continues to move to the downside, we will have a lower high, unfortunately, right? But we don't have it yet. Today isn't done. Today started out as a red candle. If this day continues to the downside, we will now have a valid lower high, but we don't have that yet. What we are looking for is a higher high. We want to see a full set. A full set is 2 higher highs and 2 higher lows, and that would be a valid trend reversal off of these lows. This bear market isn't done, not by any stretch of the imagination. We're kicking off earnings season this week, and it's very likely going to get a lot worse before it gets better. The job numbers were really good. That's one of the things that was really difficult about last week, but really good data. It's really strong data. And unfortunately, that means the Fed has a long way to go if they're looking to tamp down this runaway inflation. So more rate hikes, right? That would be kind of the outcome of the situation. The indicator that we're looking at right here is how far above the 10-day moving average are we? Think of the 10-day moving average as the starting point, the midpoint between the basketball court, right? Like center court on a basketball. When we get too far to either side, the market pauses and waits for the 10 to catch up, or it will reverse there and go back towards the 10. Each market has their own distance because how far is too far? All right. So I made this indicator so that we can put any market we want in there and then kind of gauge it and say, well, for this market, how far does it get from the 10 before it pauses or reverse? And for the ES, that's usually around 2.5 to 3 to the upside and about 4 to the downside. It's 4% away from the 10 on the downside. When we get around that area, we start looking for it to pause, consolidate, maybe pull back towards the 10 again. Well, right now, today, we are just barely, not even a half of a percentage point above the 10. And of course, we're pulling back towards it. So from this perspective, we're in the middle. We have the capacity to make a 3 or a 4% move either to the upside or the downside because we are not overbought or oversold. I don't like those phrases to begin with, but it's the ones that are most easily understood and recognized. We can use them. So for today, we've got a couple pivot points already mapped out. The red lines here, this is half of an ADR. That's 38.50 to the downside and 39.50 to the upside. And then a full ADR is 4,000 on the upside and 3,800 to the downside, right? Nice round numbers this morning. I mean, just couldn't ask for anything better. The ADR is 2.5, and keep in mind that that would be a normal move in the market. So if we were to make an outsized move today, then making a 3.5 or even a 4% move would not be out of line. But even to get such a move, we would first have to work our way through the pivot points and kind of consider these as milestone or benchmarks, right? We get to the next one and then we say, okay, we made it here. What's the likelihood we're going to go to the next one, or are we going to reverse and go back where we came from? We had a lot of that on Friday, right? We would get to our pivot point, we'd turn around and run back the other way, get to the pivot point, turn around and run back the other way. The only good thing that I could say about Friday is that it was spot on with our pivot points, and that's about as good as you could ask for. And it was a nice range. You know, it wasn't a wadded up piece of bubble gum like what I usually call it. So what do we got for today? Well, there's only 3 scenarios: that we stay range bound, that we break out to the downside, or that we break out to the upside. And that's it. That's really what we got. So what's the likelihood of each? Well, we already broke out of the bottom of Friday's range. So we had an inside day breakout, but it didn't stick, and we came right back in. Right now, we want to keep our eye on that low to see if we're going to retest it at least once more, or if we're done with it, we're going to hold the line. The range for the day is the box that I just drew. All right, so we're talking 39.22 down to 38.68. I would even argue that it could be today's low instead of Friday's low, which would put us at 38.63 to the downside, and then 39.22. So if we were to stay range bound, that would be it. What I like to do if I'm looking at a range day is to break these down into quadrants, because if we just talk about that really big range, that's a really big range, about 50 points, right? And so if we can chisel that down a little bit, put it into something more manageable, then the RTH open of Friday and our Globex low this morning would be one quadrant or range. And then from that, say, have another one from Friday's close to the RTH open. That would be perhaps quadrant 2. And then from Friday's close up to Friday's high. And we could look at that as the 3rd quadrant. All 3 of these quadrants, though, would still be considered a part of the range day today. They would, again, just be milestone or benchmarks for each one of those, right? And there's more pivots that we could have added. There was a Globex open, the Globex high from Friday, even the Globex or the RTH. I guess we got them all. Then we got Friday's low, RTH low. Yeah, the only one where I didn't mark, or the only 2 that I didn't mark, is the Globex high and the Globex open from Friday. Both of those line up so close with our Sunday open and our Friday close that I didn't bring them over. Right? I'd rather use what I have closest to me. And if the lines are going to overlap, then I'll get rid of the ones farther back. So this is our range base case, right? That we just maintain this for the day. We are down, well, we were down 0.75%. We're off of our lows of the session, but still down. We're starting to build a 15-minute head and shoulders, which is perhaps a little interesting. If we want to measure out the follow through for that head and shoulders, we're looking at basically 3,900 for a full move. It's 38.95. If we want a half of that move, it'd be 38.87. 38.87 lines up with the RTH open. I love it when our technical analysis overlaps with other numbers. So for that head and shoulders to play out, we're looking at right under 3,900. So for a downside move, if we throw out base case and talk about things getting negative, we want to perhaps widen our perspective a little bit more. When we widen our perspective, we can see that there's a significant level of resistance at the 39.40, call it 39.35 to 39.40. So even if we had that topside breakout, there is still a significant level of resistance to deal with. Otherwise, we're just maintaining this box that we've been maintaining for a while, right? The box being from 39.40 down to 36.30-ish. To use more basic numbers, you could say like 39.50 to 36.50, right? Something like that. 300-point range. So if we consider this to be our topping pattern and that we're done with the range, we're going to start working our way back down through these levels and the cog lines that are there with them, right? So we got a cog line at 38.11 and 39.31. And then there is one at 39.11, but it's so close to 39.31 that I don't normally keep it marked. All right, we're looking at a 10-day, 30-minute volume profile and a TPO profile. We are back inside the box. We got outside of the box last, well, we opened outside of the box and came back in it. Let's say it that way. This is where we can really visualize that resistance overhead that I was talking about between, say, 39.20 and 3900, especially at 39.11, the cog line. This is a significant level of resistance up there, volume resistance. Point of control is 38.25. When we are at the top of the box, we have every expectation of going to the bottom of the box. And when we are at the bottom of the box, we have every expectation of going to the top of the box. Mapping out the 5x5, we do have an untouched point of control from Friday. It's around 39.05. I'm surprised that it's not at a cog line and it's not at the roundy, so it's a little bit of a surprise. But it is an untouched point of control. We tend to carry those forward until they get hit, right? Until it's touched. We have another one that hopefully we won't see anytime soon, but we have one down here at 37.5. And an argument could be made, I mentioned it the day after we found it, that there's still an untouched point of control at 38.31. Because, you know, we didn't get through it and onto the other side of it on this day here, right, on 7/6. So as far as I'm concerned, it's still an untouched point of control. So we just carry those forward and look to see a reaction from the market when we get to those levels. It looks like we're going to get an inversion in the yield curve again. So watch that 210 spread. Again, we got almost parity within the euro US dollar. And we have the US dollar index, the Dixie, the DXY, has an inside day breakout now. Nice, very clean, very uniform trends to the upside and breakout. I was actually looking at this algo play on late Friday. You know, it's trying to validate that in the moment when that is happening. It's always a little difficult, but when you spot it later on, going back and looking at your charts, you know, it always gets my attention. I tend to take a little time to study it. This is 100% computer-based trading, and you know, nobody wants to share when they develop new trading tools, new trading systems, different algos that can do different things, and it's kind of on us to spot those on our own, right? What were they using for the criteria for this, right? It's kind of what I was thinking about when I was looking at it. I don't have any answers to it. It's just whenever I find something like this, I usually spend quite a bit of detail or quite a bit of time looking into the details that I can put around it. because once we identify what a particular machine or an algorithm is designed to do, then we start to put some edge around it, right? That's how VWAP for the longest time became such a great thing. And now, it's overplayed. Everybody focuses on it so much that they're turning their algos away from it more and more and focusing on other things. Consistent, persistent move this morning in the dollar. Very nice swing highs and swing lows since the open, right? Just very clean, very uniform trend. And now we are inside day breakout. We're talking about a dollar above the dollar index. I always want to specify this is the index we're talking about, not the actual. We're above 107.5, right? And you're talking about seeing the dollar above 108 this week. Try to put that into a little bit of perspective. This is a monthly log that goes back to 2000. And, in the dot-com bubble and 2001, 2002, 2003, right around in those time frames, that was the last time that we had a market at 120, 115, right? And nowhere on this chart we haven't been above 120, 110. And we're looking to get there this year. I am looking for a new trade on the dollar. Not yet, because we're just breaking out. I want to see this thing stabilize and find some support. Our benchmark with the dollar is that if it was above 105, it would be bearish for the market. It would be a bearish connotation for the market. This would put pressure on the S&P and the NASDAQ. Well, we are definitely above that 105, but it's more of a macro. All right, some very exaggerated moves in oil. Things seem to have calmed down. We're still within our own boundaries from Friday. We're looking for an inside day breakout to the downside. And the cyan line that you see here on this chart, that's the 4-period daily moving average. I tend to use that for bullish and bearish surge level and aggressive trading. When we're crossing through it or above it on the upside, the idea is to keep track of how far away from it we get, and are we moving away from it or are we moving towards it? And then, of course, when we cross over to the downside, it's the same thing when moving in the other direction. Are we moving away from it or back towards it? So right now, oil has been tagging it a few times. It hasn't really managed to break through it with conviction. 101.5 is Friday's lows. So we're looking for an inside day breakout in oil and a move below the 4-period moving average. So that would be a very bearish move. I don't think it's going to play out that way, but we'll see how it goes. The dollar is still a better asset for gauging global risk and sentiment than the VIX. Skew levels are really, really low, and the VVIX is at all-time lows. And those two tools are how we gauge what are the institutions doing out there, because they can get on TV and talk mad cash all they want, but at the end of the day, it's where they put their money that really tells us about what's going on. And with that in mind, if you look at something like the VVIX, look at where we've been in the last few years. You get the housing crisis, just a second. Think of the VVIX as the implied volatility indicator for the VIX itself, right? It's not that, but it is the clearest way that I could ever try to explain what it is. It's not like you can take an implied volatility indicator and put it on VIX. So this would be that kind of representation. And if you were to think of it like an indicator, like implied vol, then you can see that we're at these very low levels. This is saying nobody's hedging and that there's no volatility in the VIX. This is our current VIX level through COVID, the year after COVID, into this year. Where's the volatility? There really isn't any. And yet, if we go out and look at, say, SPY, pre-COVID, look at the size of these candles. The moves on a day-to-day basis from close to close is really what volatility measures. Nice, clean, uniform candles, very low ATR. ATR is a volatility indicator. We were at a very low levels, 2.5. Right now we've got an ATR of 8.5. Look at the size of these candles, the scope and the distance and the sweeps of the moves. This is pure volatility. It's exactly what volatility looks like. But the implied volatility is just not coming in. For you options traders, this is critically important. And for you beta traders, the ones that are beta weighing your portfolio and adjusting it accordingly, or for anybody trying to find a hedge, the implied volatility is in cyan. You can see that we're kind of sitting at low levels. And in fact, it is pointing to the downside and it is decreasing, saying, yeah, there's no real volatility out there. On the other hand, if you look at real volatility, not implied volatility, real volatility has been picking up since the first of the year. And is continuing to drive upwards. Now, everybody's agreed that this low isn't the low and that we're very likely to retest the lows again. Just kind of keep that in mind. Should things begin to get really nasty out there, the VIX may be a very, very belatedly start to move, but we wouldn't want to trust it. We still don't trust it. We don't even want to really use it for our hedges because it's not paying out well. And I mean, that really is the way that it is. So whether we like it or not, you're better off hedging within your own products. So if you're, say, trading calls in Apple, hedge with other options in Apple.
Well, I'm trying.
Well, I don't know what's going on with TradingView here. Yeah, there it goes. All right, we're looking at the S&P. We want pre-market change percent. Use the filter, knock it down from 500 names to about 100 names. It's always a little tricky. Just kind of get close, right? Get a little ballpark. That's a little closer. All right, so pre-market change percent, we give it a color adjustment, so it'll be a little more responsive, a little more quickly. The main takeaway differential between the S&P and the NASDAQ is that the NASDAQ 100 does not have financials in it. So when I'm looking at it like this, one of the first things that I gravitate to is what's going on in the financials. These heat map grids, the size of the box is based on their market cap. So the monsters of tech really stand out. Tesla, Apple, Microsoft, Google, Amazon, even Nvidia and Facebook, much smaller boxes, but they still fit into that category as a monsters of tech, the MOTs. And as you would expect, with most of the market down this morning, we're red across the board, risk off sentiment. We're going to be looking for that capital rotation today. Where's the money going? Is it going back into um, staples, real estate, natural gas, commodities? We see a lot of flat ones here. The gray boxes show a lack of advancement or decline. So that might be a direction worth taking. If we leave the S&P, jump over to the NASDAQ 100, we don't need a filter because it's already 100 names. It's already set to pre-market. Just give it a color adjustment. Tesla stands out significantly. Honeywell and the rest are either flat or down. So at least it's not highlighting any particular sector yet. That's going to be our main thing, right? Is looking for that rotation come in if we get one, right? In a highly correlated market state, everything will go to the downside. There won't be anything running the other direction. That was odd. I've never seen it do that. All right, bonds, natural gas, building materials. Those are the ones that are looking even remotely, even slightly good. The rest is down. Seems that Bitcoin is leading the way, at least that Bitcoin ETF down more than 6%. Energy and emerging markets. Emerging markets is down almost 2%. That's a considerable move to the downside for emerging markets. And we use that one again for like a risk off, risk on global sentiment. Energy. And one thing that I look at in the mornings when I'm going through this list is we know we need finance or tech, right? And we need at least one of those two. So when I'm looking at the list, I want to see how far each of those are up or down and, by how much. So we're looking at XLK, that's tech, down near 1%. And then we want to find XLF, which is down less. It's only down 0.75%. So tech is doing a little worse than finance this morning. Want to watch for any kind of rotation there too. See if it's going to pull back around, take it the other direction. All right, everybody. It is my day to stream, so I will be in around 9-ish in stock and options channel, and we'll get started with our day.